Hey, how's it going, everyone? Today's topic, I want to discuss insurance annuities and explain the concept of an annuity if you think of it as the opposite of life insurance. How you could leverage an annuity for either a protected growth account if you're trying to accumulate your dollars properly, making sure that you're not trying to leverage it for income, or for a majority of individuals trying to use an annuity account for an income play. So, how can you conceptualize the difference between how a life insurance policy works versus how an annuity policy works, and see if I go and I place monies into this sort of account, I know that me and my spouse will not outlive this sort of income stream that will come to me on a monthly basis, semi-annual basis, annual basis, how you set up this account. So it's going to cover a couple different areas. And most importantly, I want you guys to avoid the most common mistakes. Mistakes meaning losing control of your monies through a process known as annuitization. How you can leverage things known as income riders, if that might be suitable for your situation and the goals that you're trying to accomplish. And just kind of go through a couple of the more popular annuities available, but making sure that you're not falling into some of the traps that a lot of individuals do fall into. So to get started, it's all about what your goal is when you're trying to leverage an annuity account to to line it up with your retirement situation. So the first reason why somebody might leverage an annuity would be for a type of income insurance. What I mean by that is when somebody leverages life insurance, what are they doing? That person is placing premium dollars into a plan, and this plan has a type of death benefit that's tied with it. So let's say if the person's putting a couple $100 every single month and they're living, life insurance protects this individual from dying too soon. Meaning if they pass away too soon, or whenever they pass away, this death benefit, this lump sum death benefit, going to get paid over to beneficiaries. So let's say if the person put $1,000 into a plan and they had a death benefit of $500,000 and they're paying monies into the premium and into the plan, annually, monthly, whatever that is. They're paying it. All of a sudden, bam, unfortunately that person passes away. $500,000 would get left over to beneficiaries in the form of a lump sum. Now with annuity accounts, specific with the income play, it's the complete opposite of that. So rather than try to create an insurance that's going to protect an individual from dying too soon or protect their family from that individual dying too soon, what you're doing is you're leveraging a lump sum dollar, placing it into a plan with an insurance company, and then that insurance company is going to have some sort of contractual guaranteed payments back to that individual could not outlive. So as an example, let's say somebody has $100,000 of a lump sum and they're in their 60s and they say, okay, I could either go and start pulling out, $5,000 per year from this sort of bucket, from this sort of account. And I know that if I live for 20 years, I will be fine. If I live before 20 years, if I pass away before 20 years, I'll be fine. If I pass away after the 20 years, I'm ultimately going to be screwed because I'm going to run this well dry. I'm not going to have any more money in there. So what they would do is go to an insurance company. The insurance company would say, okay, based on what your age is, based on what your sex is, we could go and we're going to calculate this actuarial data for how long you should be living. So if you give us $100,000 today, we're going to be able to pay you $7,000 either starting immediately or in a 1-year deferral, whatever that is, for the rest of your life. So what that individual's doing is it's taking the risk off of their plate. It's giving the risk to the insurance company, and the insurance company is leveraging their actuarial data to say, okay, how long should this person live? And we'll produce some sort of guarantee that will give them a payment, every month, every year to the day that they pass away, them and their spouse passes away. So as life insurance works, that it protects an individual from dying too soon, what an annuity account does is it protects an individual from living too long. So that's the basic component of an annuity. So rather than an individual go take their $100,000, try to invest it on their own, and let's say if they're leveraging investments, well then there'll be certain fees with investments. So you could have different expense ratios with those investments. If you're leveraging an advisor, you could have an advisory fee with those investments. If, let's say, you're taking out withdrawals, those would be negatives to that account. If, let's say, you have a downward market loss that occurs, that could be a negative to the account. So ultimately, if you have too many negatives that are working against your account, you could run your well dry. You could ultimately run out of money that's placed into that specific account. So this is why individuals should not leverage a growth-related strategy for an income-related need. Just like they should not be leveraging an income-related strategy, like leveraging an income-related annuity as an example, for a growth-related need. It's counterintuitive. It's not going to basically be the most effective tool to use for what you're trying to accomplish. Can you use specific accounts to try to do a jack of all trades type strategy? Meaning, can you leverage growth-related accounts to produce income? Of course you can. But whether or not it's going to be successful is going to be dependent on some factors, some outside factors, on what's going on with the investments themselves, what's going on with the market, and all of that. So an individual that's more risk averse, that says, okay, I just want to make sure that I'm having a safety net and it's producing me a high cash flow. What is the best option available? What is the best option that's not going to be hindered if I'm in my 60s, I'm in my 70s, I'm in my retirement years, where I need this account the most? I need cash flow to be relying on cash flow the most. How can I make sure that I have this type of peace of mind, this type of insurance that would, these monies would always be coming to me? So that concept is the overall basis of an annuity and why somebody leverages an annuity. Now, unfortunately, there's a lot of bad accounts out there. And in my mind, or in my opinion, there's more bad accounts out there than actually good accounts. So there's ways on how you could cherry pick and look underneath the hood and determine which one would be the best one for your specific situation. And it comes down to, if you're looking at it for an income play and you're trying to leverage an annuity for a max income, understanding the difference between something known as annuitization versus triggering income through something known as an income rider. So the basic component of annuitization is where somebody is trying to trigger lifetime income from an annuity account and they're surrendering control. They're losing out on flexibility of control of their money to produce some sort of income payment. So the most basic type of annuitization factor would be a single life only option. And what that would mean is, if we're looking at it from the sense of, I want to place dollars in with an insurance company, put it into an account, leverage the insurance company, their actuarial data, and they're going to produce me some sort of cash flow. Let's say if somebody went and they put $100,000 with company ABC, and this company was leveraging annuitization as their income option for a single life only option. And we would say that they're going to give this person $7,000 as an example. Well, if this person is living and living and living, and all of a sudden they pass away prematurely, let's say they pass away after 3 years, they would have put in $100,000. The insurance company would have paid them for 3 years, which would be equivalent to $21,000. And then they would stop giving payments because obviously that individual passed away, so their life is no longer relevant to what the contract was set up with. So this additional $79,000, if somebody did leverage the life-only option, this $79,000 would go back to the insurance company. So that's one form of annuitization, and it pisses off a lot of people, and it pisses off a lot of family members, because if, let's say, the individual passes away shortly, well, then the insurance companies are making out like bandits, because that individual, they said, okay, it's going to be only covered on my own life, and this is the route that I want to go with, and I understand what the risk is involved, but then the beneficiaries receive nothing. So individuals try to stretch this out a little bit, and they might say, okay, with an annuitization option, another type of annuitization option might be a single life with 10-year period certain. And conceptually how that works is, let's say if you have that same $100,000 amount that the person gives, instead of getting paid $7,000 because there was a larger risk to that single life only payout option, they might produce this person, give them $6,500 with a 10-year period certain. So in that same example, they would be receiving $6,500, $6,500, $6,500. If this person passes away, because that happened after the 3rd year, they still have 7 years worth of payments with the 10-year period certain. So the 7 years worth of payments multiplied by the $6,500, that's the amount of money that would get paid over to the beneficiaries. So it doesn't entirely make them lose control. It still could allow the individual to leave something to their beneficiaries. But in my mind, I still think it's a shitty way to do it. And this is why I have a real problem with immediate annuities. I have a problem with DIAs, deferred income annuities. I have a problem with QLACs, qualified longevity annuity contracts, is because it's leveraging that annuitization table. I like the concept of income riders. And the reason being is because what an income rider could do is allow an individual to still have growth on their physical money as they're leveraging the insurance company to produce that lifetime income stream for a single individual or a joint individual. So also, if let's say interest rates change sometime in the future, there's certain get out options where they could take their monies, pull it, and place it into something else, whether that be a fixed product like a bank CD or fixed product like a fixed annuity or something like that, or throw it back into the market if the market's looking favorable, but it gives that person more flexibility. On top of it, when we look underneath the hood, income riders, majority of the times, not all the time, but majority of the times, the income rider lifetime income mechanisms produce a higher rate of return, produce a higher cash flow than annuitization and single life only annuitization tables, where you lose all flexibility with annuitization. With income riders, you still have the flexibility there. So an income rider is an additional mechanism that's attached to an annuity account. If we're trying to have an apples-to-apples comparison between annuitization and income riders, let's say if we're going through a contract ABC that's going to produce an individual lifetime income through annuitization versus company XYZ that's going to produce an individual lifetime income through an income rider, how do these work from an actual income perspective? Not even saying from the flexibility perspective, but just for the income perspective first. Company ABC that's using annuitization, let's say if this person gives $100,000 with ABC, after all said and done, let's say they wait 1 year, 2 years. We have a male that's age 60, looking to trigger income at age 62. Company ABC might give this person an offer of, say, you give us $100,000 now, you wait 2 years, we're going to pay you back $6,000 every year to the day that you pass away. Company XYZ is going to pay this person with a lifetime income rider. So if you give us $100,000, we wait 2 years, we're going to pay you back $7,000 every year to the day that you pass away. So from a cash flow perspective, obviously 7,000 is higher than the 6,000. You're putting 100,000. Why would you go with company ABC if you go with company XYZ with the income rider? On top of it, the income rider gives you more flexibility, allowing you to have control on your physical money. If let's say this individual, starts receiving income at age 62 and they live for 3 years, and unfortunately they went with the single life only option through annuitization. They live for another 3 years. They would have been paid back $18,000 of total income. At age 60, they gave $100,000. So now the insurance company's able to keep $82,000 in this example. That goes back to their pockets. This one, let's say if they're receiving $7,000 per year, this person lives for 3 years, unfortunately passed away at age 65, they would have received $21,000 of income. The $79,000, if let's say all things being equal, there was no growth, there was no income rider fee, nothing like that, and everything was just a 0% rate of return for those 3 years, keeping everything level, $79,000 would get left over to beneficiaries. So it allows the individual to have the peace of mind that they're able to leverage the insurance company, receive lifetime income, but then still have access to their account balance, still be able to leave their account value to beneficiaries. So an individual could add income riders to a fixed annuity or fixed indexed annuities. The ones that I like to leverage when somebody's looking for lifetime income is the fixed indexed annuities with income riders. Some of their marketing terms are known as hybrid annuities. And for this purpose, I want to just explain what a naked fixed index annuity is, or what a naked fixed annuity is without the income rider, and then be able to show you the concept of adding an income rider to those sorts of accounts so that you know how your account balance could go down, how you still have money growing in that account when you're adding the income rider to it, what are some of the pros, some of the cons, all of that. But if we're looking at it from an insurance side, and an individual wants to leverage an annuity account specifically for the growth play, meaning that they want to have market protection, some sort of insurance that their account will grow whenever the market indexes that are linked to it increase, but have an insurance have a 0% protection whenever the market indexes that are linked to it go down. A fixed annuity versus a fixed index annuity. With a fixed annuity, everything's fixed. So let's say if somebody was in a 5-year fixed annuity and there's no income riders or anything attached to it, and they were getting paid a 4% rate of return, we know after the first year they would get a 4% into their account. After the second year, 4%. After the third year, 4%, et cetera, et cetera. For all 5 years, they would receive a level 4% interest rate. If the market went up, it didn't make a difference. If the market went down, it didn't make a difference. Everything's fixed. Very simple with how that works. A fixed index works similar, but an individual typically goes with a fixed index annuity when they want to have a higher potential rate of return than a fixed annuity. So what they will do is they would go and, similar to how that individual would, let's say they were in a 5-year fixed index annuity, instead of getting that fixed interest rate every year, regardless of whatever's happening to the market performance, an individual says, I don't want to receive a fixed interest rate. What I want to do is have an interest rate that cannot be less than 0% every year and could have some uncapped growth based on the different index options that are available with that specific company that's offering the fixed index annuity. So as an example, let's say you have company XYZ, that they have a 5-year fixed indexed annuity, and they have an uncapped index that's associated with their growth. If the index, let's say, gains 7% the first year, then it loses 10%, then it gains 5% the third year, then it gains 12% the fourth year, then it loses 30% the fifth year. How exactly do these credits work? Rather than you get that fixed rate because it's a fixed index, it's an entirely different account, entirely different product. In this example, this individual will receive a credit of plus 7% the first year, and now that credit is protected. So if they had $100,000 and they got a 7% credit after the first year, their account balance would be sitting at $107,000. The next year, when the market index came back negative minus 10%, they're going to gain 0. The next year, when it had a positive 5, it's going to be 5% on top of this $107,000. The next year, it gained plus 12. You'd get that plus 12% on top of that higher number. The last year, if it lost 30, you would gain 0%. So the reason why individuals like to leverage these sorts of accounts is because, this sort of account has a plus 7, plus 5, plus 12, which comes out to plus 24% interest, which is higher than the 4% multiplied by 5 years, which is, a 20% total interest, as an example, with the fixed annuity. So some years they might get a double-digit rate of return. Some years you might gain 0%. But that individual likes that move because they want to try to push the pedal to the metal. They want to try to get a better growth rate, but still have that sort of insurance, that market protection in their corner to make sure that they could leverage it properly. And it's meant for the correct safe accumulation dollars. So when somebody's attaching an income rider to a fixed or a fixed indexed annuity, what's happening is their physical money is going to be growing like that mechanism that I just mentioned. But you're going to be, anytime you're taking out withdrawals from those accounts, those withdrawals are going to be reducing the account balance. So if you have some years where you have a 0% market performance, meaning your account didn't gain anything, but you took out $7,000 that year, well, then your account value will reduce by $7,000. If, let's say, you also add an income rider that has an income rider fee, some income riders have fees, some don't have fees. But let's say if you had one that had an income rider fee with that, and that fee was, an extra $2,000, and you didn't have any growth that year, if you pull out $7,000, it's going to be $7,000 and the additional $2,000 for the rider fee, where that will obviously reduce your account balance, reduce the dollars that you have, control of, that flexibility that you would be able to leave to beneficiaries or be able to walk away with after you've, accomplished the set duration of time. So you have some accounts that have a 5-year duration. You have other accounts that have a 7-year, a 10-year. And what that means is you might have a certain point that you can't fully remove your monies out of those accounts. Or if you do, you get hit with some sort of surrender penalty. So that's where like a 5-year account would, if you try to remove your money after the 6th year or after the 5th year, you have full access to those dollars. But if you're in a 10-year account and you try to remove your money in the 6th year, then you get dinged with a surrender penalty. So that's why you have to be careful. And some accounts are shorter term, allow you to add the income riders to it. Others are longer term, allow you to add the income riders to it. Some accounts are shorter term that you're not going to want to add income riders to because you're trying to use it as a growth play. And so there's a whole multitude of different things. This is where we try to help out individuals and we try to help them navigate. So we're an independent agency. If you are interested in seeing what are some of the best options available for an income play or a safe accumulation play, feel free to give our 1-800 number a call. It's 1-800-566-1002. Reference this video and ask to speak to a specialist. So that just went over the different goals that somebody might have and why, if you think of an annuity as a type of insurance, how you could match it up correctly. Now, what are some very common mistakes that an individual should be avoiding when it comes to annuities? And the first mistake has to do specifically with inferior cash flow results. So like as an example, if you have hundreds of different carriers and hundreds of different options available to you, you say, hey, I have $100,000. I want to go and place it into something that will give me some sort of lifetime income cash flow for either me or me and my spouse. If you have the first place option is going to give you $8,000 of income, versus the second place option that will only give you $7,000, versus the 10th place option that will only give you $4,500, versus the 100th place option, which might only give you $3,500. Why would you be interested in leveraging these inferior options? Go with what's going to give you the most amount of juice that you could squeeze from there. And that's where individuals make the mistake time and time again. They might talk to a retail advisor that could only sell one company, and they're trying to shove that one company down their throat. You might have an individual that sat down at a dinner seminar, and that advisor is just trying to push one company. The odds that that one company and that one product is going to be the best one for your situation is slim to none. If you have 1,000 options, what's the chance that your specific age and your specific deferral time period to trigger lifetime income is going to be ideal for that exact one product? Sometimes we do see that where you might have, one company is really good for the individual that's 63 years old that's looking to wait 2 years for a deferral, and they could be also the first place option for a 63-year-old waiting for a 5-year deferral. That happens. But, regarding your situation, it's all about how can you place the smallest dollars and only as much as necessary into the superior product. So like in this example, if somebody had $100,000 to invest and all they needed was $6,000 of income, can they go and take the $100,000 and put it with the best option at $8,000? Yes, they can. But why wouldn't they just use less money, put it with the top carrier, and now they get to save an extra $10,000, $15,000 in their pocket, and they're leveraging the smallest dollars and only as much that needs to give them that $500 a month or $6,000, cash flow per year. So that's where, things get a little bit complicated, where individuals typically, fall for those common mistakes. And that's something that you should be avoiding at all areas. The other common mistake is when someone's looking underneath the hood to leverage an income rider, they might automatically be gravitated towards income riders that have fees associated with it. Or they might think that, I could go into an annuity, but annuities are just bombarded with fees. We have some annuities that don't have fees. Yes, all annuities will have some sort of surrender penalty, and you could include that as conceptually like a fee. But because the insurance company is not going to give you all these benefits, there has to be some give and take. There's no such thing as a free lunch. So like as an example, if part of the terms of your contract is you have to sit in there for at least 5 years before you could fully remove your monies, then the insurance company might give you growth when the market goes up but not lose when the market goes down. With an income rider, you might have some accounts that have no fees with their income rider, where it's built into the plan, and then other accounts that they do have a fee. They might say, okay, we're going to, charge you a 1% fee. So when push comes to shove, when you're looking at the top results, or where we help individuals find what the top results are, we might have company ABC that's going to pay this person an 8% cash flow, or $8,000 per $100,000 that they're placing into an account, versus company XYZ that's going to give this person $7,950. But if company ABC has a 2% income rider fee versus company XYZ that has a 50 basis point income rider fee, those are pretty close numbers. Where it might not make sense to go with company ABC because that income rider fee is really large. Also, on the physical money, on the actual, like the fixed index annuity that you're using, you might have one that has an uncapped indexing strategy with company XYZ. They're still giving a favorable income stream, but your physical money could grow a lot better than with company ABC. That might be a reason to go into second place or third place. So it's always important to go with the top option, but you don't want to rely solely on the income side. You want to make sure that if there's not a large variance between first place, second place, third place, well, then you start looking at some other factors. One that might give you like a long-term care doubler benefit. Others that might recredit you back the fee if your physical money does not beat out what the fee is every 5 years or every 10 years. So there's some nice little sweet spots that, that an individual could leverage if they're looking to use an account for lifetime income. The third most common mistake that individuals should avoid are low caps, low participation rates, and or high spreads. So like a low cap, simply put, if you have an index that has a 10% cap versus another index that's giving you a 5% cap, go with the one with obviously the higher cap limit, because if they both have the same index available, why would you go with the inferior cap limit? Go with something that could give you the higher rate of return. Participation rates. What we've noticed, especially with the interest rate environment change, is you used to have companies that might have like an 80% participation rate on an index. What that would mean is, let's say the index gains 10%, this individual is going to get 8%. Now with the new rates, that same sort of index might be receiving 120% participation. So that means if that index gains 10%, an individual is going to get a 12% credit on their physical money on that bucket. So some of these nice uncapped indexes with high participation rates have historically generated really, favorable rates of return, much better than, what it was in just the last, 6-9 months. So, those are obviously some good things. Always make sure that you're getting set up. If it's an uncapped strategy, make sure it's not uncapped with like a 20% participation rate, which really doesn't do anything for you. Do something that could be uncapped with 100% plus participation rate and really give you some extra juice into that account growth. High spreads. A spread is basically it's a fee that comes off of an account whenever the index is positive. So like, let's say if the index comes back at plus 10%, but this person had a 2% spread, well, then the individual would only receive an 8% credit because the spread would come off. But if the next year that same index lost 10%, that individual will receive a credit of 0%. So the spread doesn't hurt somebody, doesn't allow it to go, less than zero. That 0% floor is still going to be that nice mechanism on a fixed index annuity. But still, be mindful. Make sure that it's something that's going to give you the best possible growth potential in your account. And lastly, the different things to avoid is don't just set up a portfolio. Make sure that you're creating a plan. Because if you have specific goals and an annuity is not going to accomplish any of those goals, then don't get set up with an annuity. Just like if you have an income-related need or you want to have really safe growth and somebody's trying to shove investments down your throat, well, investments could be meant for a growth-related need. It's not going to be meant for more of a conservative need. Or let's say if you have a short-term income need where you need to access dollars within the next 12 months or 2 years or 3 years or whatever that is, well, an annuity is not going to be the right fit for you. So that's why too often we see individuals have portfolios, whether that's they have portfolios with their 401k accounts, their IRA accounts, and they don't really know what's going on with it. They just want it to grow, but they don't know how to actually create it into some sort of financial plan. That's the difference. You could use these annuities as individual tools in a tool belt and make sure that each one's being optimized correctly so that it's being most efficient for your overall plan. An easy mechanism that you could leverage to try to put together an optimized financial plan would be looking at your 3 things scenario. If you're currently retired, if you're in retirement, or if you're nearing retirement, what are the 3 things that you need to figure out in order to have retirement success? And the first thing is you want to make sure that your income sources are going to be greater than or equal to your expenses. Once you can accomplish this goal, then you can move on to step 2, which is whatever you don't need for this income-related strategy, you could leave a portion of dollars in an emergency need in case of an oh my gosh moment was to occur. So leave about 6 to 12 months of what your expenses are into some sort of liquid account, whether it be a checking, savings, money market account, based on what sort of account qualification it's in. Third is growth/inflationary need. So let's say we have a scenario where an individual has $1 million of assets. They have it in a combination of cash monies, of Roth IRA monies, and IRA monies. And we understand that they have a specific gap in their income. They have X amount of dollars from Social Security income. They have no pension income. They have no income streams coming to them other than Social Security income, but they have expenses that are higher than their Social Security income. Well, what is that gap? How exactly can we try to close up that gap? Well, that might be leveraging a type of insurance, a type of annuity insurance that we're trying to say, okay, if somebody has a $20,000 need, maybe that's going to mean taking $200,000 from this $1 million and creating a strategy, leveraging annuities or laddering up different annuities on the income side to make sure that this will accomplish the $20,000 gap. Now they have $800,000 remaining and the emergency need. Maybe in the emergency need, they want to leave $50,000 into some sort of liquid account that they could leverage as a rainy day fund, as an oh my gosh type moment, as an emergency need. And then step 3, now because we only used $200,000 from their overall bucket of $1 million into the step 1 and $50,000 for step 2, this individual now has $750,000 that they could have fun with. They could go and leverage this towards, if their risk tolerance abides by having an aggressive play of leveraging investments or leveraging safe accumulation play like a fixed annuity or fixed index annuity or bank CD or whatever that is. They could take a portion of dollars, put $250,000 into different investments as an example. Put $200,000 into a fixed account, put another $200,000 into a fixed index account, leverage another $100,000 into something else, et cetera, et cetera. And they can really chop this up into a few different ways that are based on what their goals are. Maybe a portion of these monies they want it growing just primarily as a death benefit need to their beneficiaries or to a charity. They could have it as like a vacation fund. So there's a whole multitude of things you could do. But when you're now organizing your plan and you're not just creating these little portfolios, but you're actually, each thing is serving its purpose, it's going to bring retirement success into your life, and it's going to bring a lot less stress into going into retirement. Or if you're in retirement, how to make sure that you're able to accomplish that, with peace of mind and with confidence. The most important thing to do is to research what your situation is. See exactly where your point A is right now. What's your point B? Are you, trying to create some sort of goal, and then what would be the most efficient, the most effective route to accomplish those needs? One of the things that I like to do is beat the hell out of everything and say, okay, if I'm giving a recommendation, what are the cons? What is every single con possible? And if the cons are not that bad compared to the pros, meaning that the pros would be able to allow an individual to accomplish their need in the most efficient way, then I know that it's worth mentioning. I know that that recommendation is worth mentioning to that individual situation. So that's the way to do it, is shoot as many holes in it as possible. If it's still left standing, then that might be a viable solution for you. If you want help with your specific situation, feel free to give our 1-800 number a call, 1-800-566-1002, and reference this video. Also, make sure to subscribe to our YouTube channel, Retire Sharp, so you can have access to the most updated videos. Thanks so much, guys.